Welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio. And today we have an episode about Penn National Gaming. We're going to be kind of walking through the stock a little bit, walking you through our discounted cash flow model, kind of give our opinions on the stock a little bit, and then as well as if we think it's something that we're potentially interested in or not. So without further ado, what are we looking at here today?
Yeah, so Penn National Gaming, people kind of might know this name already because of the Barstool name. Some things I want to kind of highlight. Well, actually, we'll put a pin on that because we want to focus mainly on the core platform first, which is the actual casinos, and we'll talk about that first. And then we're going to talk about the Barstool brand and where that kind of plays in, because I think that's, if we're being honest, that's going to be the most interesting part, and I'll explain that a little later. So the first thing let's talk about is Penn National Gaming and what distinguishes them from other gaming players. And when I say gaming, we're talking about casinos, so profiting from gambling, etc., stuff like that. So they offer more of a localized regional approach, different from that of like casino players like Wynn Resorts or Las Vegas Sands, stuff like that, who primarily in the past have focused primarily on hub spots. So HubSpot, target audience, target market. And what we can understand from that is they play to a different strategy, right? And we can see within the numbers how that strategy kind of pans out. So what I actually think we should take a look at something like Wynn Resorts, which Wynn Resorts is considered to be a high-end hotel, resort, casino business. And then we'll compare that with Penn National Gaming, which again does this more regional focused approach. So you actually may or may not live close by to a Penn National Gaming casino, depending on where you live in the United States, but you don't have to live in Las Vegas to be close to one. So I know that Wynn Resorts has Boston properties and et cetera, Macau and stuff like that. So
yeah, I was about to ask like where they like primarily located in within the country itself. That's kind of like my first question there, because then that'll help me orient my thoughts as to, all right, well, what are some of the potential headwinds in terms of laws facing these potential casinos, or maybe future casinos that might open? What are some headwinds with some laws that might affect that as well? That's kind of where my mind goes immediately off of just hearing what this business is just in and of itself. So
yeah, and actually, I think for our audience, we're going to do the classic look at the presentation that the company has to kind of gauge an idea of what it is that they feel that is important for us to know as potential investors. So going into this, you have to be always aware that the presentation is kind of like a sales pitch for the company, and you have to be very cognizant about that as you're reading it, that they're only going to highlight the good stuff. They're going to try to gloss over some things, but we're going to see what it is they're trying to say is why we should be investing in them. So this is the latest investor presentation. They have this interesting adjusted EBITDA. Okay, so usually you don't see something like that. And then we want to see, for example, obviously revenue growth, 10%, net income, 87%. So what they're doing, highlighting there is some efficiencies increase. Notice that they're highlighting from 2019 to 2021. They're skipping over 2020, and I'll give them the pass on that because 2020 was a fluke year. So we want to pretend like it's a continuous operation, and in which case they're trying to highlight to us, hey, we've seen some improvements. We've seen some sales improvement. We're seeing some net income improvement, and we're seeing some EBITDA is another way of them trying to highlight cash flows. I have my own problems with EBITDA and EBITDA. So I kind of want to not pay attention too much to that number, but GAAP net income has its drawbacks, but it's still, in my opinion, better. So here's again, they're going to do some EBITDA and margins, but they're trying to tell us the impact of what's going on, what's affecting them. So here, what we can see is the California sports betting, what happened with the sports book launching. So I said earlier that I wanted to talk about that later, but I guess I'll talk a little bit about it now. The Barstool Sports, what it kind of brings to the table, that's a lot of potential growth in the sense of the sports book. So if you don't know what a sports book is, it's essentially what enables the digital gambling, the online gambling for sports that you can kind of consider if you know of anyone in your personal life that bets on sports or the outcomes of sports. That's what we're talking about with that. And then they have the traditional business as well, which is the stuff that goes on in the traditional casino setting. So if you picture in your mind the casino, if you watch The Hangover, part one, you know what that kind of can look like, right? But most people, I think most adults can know what a casino is. So again, we're gonna get highlighted the revenue trends of October. So again, they're trying to convey this message. So I won't spend too much time on that slide. Okay, so My Choice database members. So here they're trying to show the loyalty program. So My Choice is just the loyalty program. Why is this important? Because a loyalty program can show loyalty to the brand, loyalty of the consumer. So people want to come back. And actually, that's a big part of the regional strategy. So the regional strategy versus the hub strategy relies a lot on these loyal consumers to come back to the casino time and time again. And that's enabled by what they call the My Choice membership. So you actually want to see that growing, and that's more part of the traditional business. Again, that's not so much the Barstool Sports. That's kind of separate, but the sports book. So we want to see, I see way right here, they said engagement among the younger demographic continues to be strong. So they want to highlight that to us because they want to show you, oh, we're getting the next generation. And then declines from the older segment, so the older generation, because maybe older people, they're saying, are maybe afraid to go out or some around there. So you can see here 65 and older has gone down by 17%. But what they're trying to say is, hey, look, the others have offset that and it's actually grown, right? So here you can kind of see the technology highlight. They're just trying to say, hey, look at our technology. And that's more enabled with their loyalty program that we were talking about before. And if you can pause the video if you wanted to read all this, I'm just going through and highlighting what I think is important, but otherwise it would be a longer video. We want to cut to the chase for you guys. So here's what I was talking about with the regional approach. You can see that the different locations that they're highlighting here and the market share. So they're choosing to highlight these locations. And why are they doing that? Well, they're trying to show you that they are the number one in these locations. These are not Las Vegas, if you obviously can see the name. None of them are Las Vegas. And they're trying to say we are good at the regional strategy. So they have something either operationally, brand-wise, something that's showing them they are the best. And this is obviously regarding to Barstool Sports, by the way. So Barstool Sports is competing with those like DraftKings and the like. So you want to kind of think about that, because if depending on the experience that a consumer has on each platform will determine whether or not they come back. And I know that sounds obvious, but you need to be aware of that the retention of these customers is what you really want to pay attention to. And the maintaining this market share is highly important. So even if the business is, high margin, if your customers come and they hate the website, they hate the UI and everything, and they go to your competitor, it doesn't really matter. So you want to make sure that they're maintaining this. So this is something to like put a pin in and keep track of over time.
Just to keep track.
Exactly. So I'm highlighting that to keep track of it. So here we can kind of see our David Portnoy right over here. So we want to see them gain or grow utilizing the popularity of Barstool Sports. And through the personalities that such as this, that the younger demographic seems to really engage with, which is actually a huge advantage of them, because stuff that are like legacy media, which is what's really important here, like ESPN, they may, from what I've gathered from some guy, I guess like quasi interviews, is they're losing the younger demographic for a variety of reasons. I won't get into it, but they're losing the younger demographic for a variety of reasons, because the younger demographic, quote unquote, just wants to listen to sports. And the personalities on the media segment of Barstool Sports is really catering to that demand. And they really attacked college football, for example, and they've been hyper successful at it. And then through that, they're leveraging that success, that media success, and then kind of trying to create, we'll see if they are, but they're trying to create that flywheel effect where the business is supporting the rest of the business and all the business is helping the other parts of the business grow. So remember that engagement on the media segment can drive engagement on the gambling segment, okay, and drive profits. So here they're just going to highlight some of the technology, some of the app rankings. Go for your question.
So basically, like this, obviously, like
we'll pause
obviously
here.
one can gain from here that Penn National owns, at least in part, Barstool Sports. How much credence do you give to the idea that Barstool Sports is really a reason indicative alone to be bullish in this company in and of itself, if that makes sense what I'm asking?
It makes entirely sense. And I think it's like, it has everything to do with the consideration. We're not looking at the financials, just looking at like a bird's eye view, just a quick glance at it. That's all that you would really care about, because otherwise it's just a casino operator, a good casino operator, perhaps, but that's all it is. And it's not addressing the massive amount of opportunity there exists in online sports betting. We are not looking at the financials yet. We will later, but yes, so correct. And for example, hypothetically speaking, again, if you're saying that Barstool Sports can grow into something like ESPN in the future, I think the valuations of ESPN is in the high tens of billions of dollars, and it's owned by Disney, obviously. So if Barstool Sports even gets close to that or half of that, the investment by Penn National Gaming will look very intelligent. So, and you would basically own it through proxy by Penn National Gaming. Obviously, if I'm being honest, I would be the most excited of just owning Barstool Sports outright directly, but I can't do that, or no one can do that unless you are those select owners that are currently there. So you have to own it through Penn National Gaming.
Yeah, because that's sort of my thing, like coming into these kinds of stocks, like me and you have talked about before. I'm really interested, at least when it comes to investing, in asking myself the first and foremost question of what do people actually need? So being honest, this in and of itself, if they did not have Barstool Sports, this would not even really be a company that I would be looking into. I would probably consider it, but it's not really entirely something that interests me at the present moment, because I like to kind of ask myself, well, what is it that people need? People need food. People need resources to make their products. That's typically the sort of industries and companies that I like to invest in personally. But like, I'm not you, you're not me. We both have our own different set of assumptions and beliefs when it comes to investing. And then so does our audience as well. So that's definitely an interesting part, because I kind of echo that same sentiment, where if I could own Barstool Sports outright, I would just own Barstool Sports outright. But, obviously we can't. But I think now it's probably intelligent to just sort of take a look at the numbers and just kind of see what the numbers are showing us with this respective investment. So
yeah. I mean, we'll see them in a quick second, but I think that I pretty much covered everything that they want to really highlight to us. They're pretty much highlighting just these other little initiatives that they have. But again, highlighting Barstool Sports, David Portnoy's personality with pizza, stuff like that. That's all. Yeah, exactly. That's all. There's a reason for that. It's like the personality in of itself is like a selling point, and can potentially drive users to the platform. So let's actually take a look at their balance sheet. I mean, before we actually see in the model. All right, we're not going to really see it here, I guess. Nice. Okay, so we'll just see it through the model. So that being said, I already have Penn National Gaming plugged in here. I plugged in a standard 20% discount rate to adjust for some of the risks, because I consider this kind of like in its growth phase. We should demand a high amount. However, I want to highlight this real quick. I think Everything Money did a video on this already. And I think their concern of Paul was the dilution over time. And he's absolutely correct. When I looked at this myself, I saw a fair bit amount of dilution going back even before the acquisition of Barstool, which shows me that the company is choosing to fund a lot of the initiatives with equity. So while companies like Las Vegas Sands or Wynn Resorts are buying back their shares over time, Penn National Gaming has chosen to dilute the shareholders over time. And I know they were paying a dividend. So when they were paying a dividend, the debt must have been more expensive, or the management is terrible. So one or the other is the case. So I'm going to err on the side of the debt was more expensive, and that's why they chose equity financing. They do have some debt. So I think they have about 2 point something billion in long-term debt. But the problem I see with that is their choice to use a ton of equity has diluted the future prospects. And if they continue to do so, I can kind of show you how that completely destroys the investment. So even if we did negative 10%, let's do negative 10% and go to 5%, because 10% is a lot. But if we say 10%, we have to assume incredible amounts of growth. So let's actually assume 30. Okay, we're getting there. 40. All right, we're there. All right, so if we assume 40% compounded every single year, that would pretty much be driven by Barstool Sports. Is it possible? Perhaps. And that would be incredible.
Yeah.
Look at that dilution. A dilution of 10% per year. And if they could achieve 40% growth rate, this actually would be a great investment. And you out there who's thinking about investing, or maybe already invested, may actually believe that that is possible. And if that's possible, these assumptions say it's a good investment. I'm assuming a 10% dilution rate. Now let's take away the dilution, and we can see that, at a 40% growth rate. Let's actually play around with this discount rate over here. Let's see what it's kind of telling us. So just about a 40% annualized rate of return if they didn't dilute you, but they're more likely to dilute you. So this is actually more likely than not, in which case you can still achieve around a 20%. But the question remains, can they do it? And let's try to find the exact amount we would have to be assuming. So it's between 30 and 35. So let's try 33. We're getting close. 34.
So 34.
We're there.
Yeah.
We're just about there. So 34% is the growth rate we have to assume, compounded over 10 years on their cash flows that they're able to achieve. And with a dilution of 10%, we could assume that. So that's actually pretty interesting, because dilution is pretty heavy. And if I say a negative 15%, to just play around with that, say they continue to do what they've been doing,
it's probably like 41%. Yeah, about that. 41%
exactly.
Compounded growth.
Exactly, which is still pretty crazy, because but like, again, the question remains, can they achieve that?
Yeah.
So I don't know. This is where a lot of research would have to be dedicated to truly understanding the potential of Barstool.
Yeah. Or the nice margin of safety there. That's where I would put that first and foremost.
Well, I mean, we're already applying a really heavy margin of safety, but like, and I'm assuming the same amount of dilution as if they keep buying new Barstools, because that dilution, a lot of it was the big amount. So they've been diluting since before the acquisition of Barstool, but when they did acquire Barstool, it jumped up a little bit more than normal. Okay.
Yeah.
So I'm assuming they're acquiring a Barstool every single year for 10 years in this dilution measurement. So I'm being very aggressive with it to be fair to Penn National Gaming. Okay, so let's actually take a look at some of the key ratios. We're actually not going to care about the activity ratios too much, because it's not really an inventory heavy business. So we want to see, for example, the current ratio has improved. They've improved their balance sheet over time. Now I know where their dilution came. They were diluting their shareholders, perhaps to shore up the balance sheet. Okay, so it's telling me a story. Now, why is that important, Austin?
Well, with a healthier balance sheet, that creates a better investment.
Well, but here's there's a problem with how investors, or some investors, and this is kind of like a newbie thing to do. You get so concentrated on the past and try to extrapolate to the future. You need to actually try to see a story. I am using past numbers. That's not what I'm saying. Don't not use past numbers. But like, if you're looking at the current numbers and you're not successfully extrapolating the story, that could be a detriment to your investing. So for example, right here, what I'm seeing is they did dilute shareholders even before Barstool Sports. But what I'm also seeing is that there is a current balance sheet improvement going across the entirety of the balance sheet. So right here, the current ratio, cash ratio, total debt ratio, long-term debt ratio, all these have been improving. So if I do something to fix a problem, will I need to do that same thing again to fix the non-existent problem? You get my metaphor or my analogy? It's not a metaphor. It's more of an like an analogy.
Explain, Fabio.
So
like,
I have a problem. I have snow in my driveway.
yeah.
I go out and I shovel all the snow away. Now, do I go out again and shovel the non-snow?
No, obviously, because you've
I've already
shoveled
done
the
it.
snow. Yeah.
Precisely. So the story here that you may be extrapolating here may or may not be true. And that's for an investor to decide. It's just an example of how you have to derive stories from these numbers, not just stare at the numbers and say, oh, ratio this, therefore this, right?
Yeah.
You gotta take out. That's why accountants can sometimes, struggle with that. And I'm saying that from both the accounting and finance background, but
yeah.
it's what accountants can kind of struggle with sometimes. It's just sitting there and just staring at these numbers. But extrapolating the story is very important. So if they've already shoveled the snow, they don't need to go back and shovel more snow. The snow's already shoveled. It's already packed away nice, neatly. The driveway is clean. So here, if they were diluting shareholders to shore up the balance sheet, to improve their leverage, will they need to do that now that the leverage is now lowered? You may conclude that it's not safe enough, right? We don't necessarily know that with this particular case. I'm just using that as an example of deriving a story from the numbers, by the way. I'm not saying that that is exactly what we're looking at here, but I am seeing improvements. And that does bring into question, are they going to continue to do as excessive dilution as they were before? And why is that important? Well, remember in the model, I was modeling out some dilution. Now that may change my assumptions on that dilution. I may feel more comfortable to lower that dilution and still give them some dilution room for my assumptions, but bring that down maybe less than 10%, right? Because I'm seeing here a drastic shift in the health of the company. Okay.
Yeah.
So that's what I was trying to get at with there. And then gross profit margins, I see this improvement. You may think that's really exciting. Well, just understand that they bought Barstool Sports, or they bought a piece of it, a big piece of it. So when they are consolidating those numbers, Barstool Sportsbook is generally a higher margin business. So I would like to know how much is that attributing to that. So I don't know if it's necessarily the on-site locations that just they've improved their operations, but it may be, but just no, it may not be. But we see improvements across the board. And I'd see their operating margins are back to 2017 levels, slightly higher, but their gross profit margins are significantly better. And the net profit margin is down. And again, that's GAAP numbers, so we'll put a pin on that. And yeah, it's enough of that, I guess. So then this is the last thing we're looking at for ratios. Then we'll come back to the model and have our closing thoughts. So here I see the quality, the earnings quality is good. I like to see that. That's a unique metric we use here. And then the book value per share, believe it or not, I actually may care about that here. Not believe it or not. Some people might say, of course you care about it, because why, Austin? Why would I care?
A lot of physical assets in this instance.
Yes. Yeah. They own hotels, they own resorts, they own casinos. There's properties, right? Properties, locations involved. You want to make sure that they actually own them. So like, for example, MGM doesn't own a lot of their casino resorts. They spun off that part into a REIT, and you could own the REIT or you could own the operator. But I think for the most part, I think that they own it. That would require a little bit more digging, but I think that they own it. And I remember that I'll take us over here real quick. In the pre-pandemic, I know everyone goes, oh, but that's pre-pandemic. They were trading below book value. And I remember that because I was looking at I was looking at all the casino operators. I ended up buying one of them, but not this one. This is the one I should have bought because it had this period of over exuberance, but you never know, but this is the one.
It's true. Hindsight's always 2020.
Exactly, because you can see here, if I would have chosen this one, and who knows if I would even held the whole time. That's the other thing. People always pretend that they would. There have been some stocks that I have held throughout crazy times, but like, who knows with this one? I might have been more trigger happy like around here. But anyway, the point is, this one was trading at below book value or at book value for quite a long time. So remember those numbers right here. Let's go back to the book value. See how they were, that was the book value around there. Going back, remember 16, 17. Yeah, around book value. So it was trading at book value. So you had a decent margin of safety. Now you're seeing a company trading significantly above book value. Okay, keep that in mind. Significantly above book value. Typically in the past, it had traded around book value. Now, you might be saying, maybe correctly so, the company has changed. Okay, the company has changed. What has changed? Well, they have Barstool Sports. Fair. Think about that in your own assumptions. Does that justify the higher book value? Does it not? Think about that on your own time and come to terms with that. So going back here, I've already discussed why I might think that this dilution actually may turn out to be less, because once the snow is shoveled, you don't have to shovel it again. And the numbers are telling me the story that they may have diluted in the past to shore up the balance sheet, right? We were trying to improve those metrics. And now this is kind of a different company, so to speak. May be true, may not be true. Okay, so that would require further research. So I think based on that assumption, we can kind of see, okay, what kind of a growth rate can I assume? About 25%. Is that doable? Perhaps. I think most of the growth rate, if we were to expect hyper growth or high growth, not hyper growth, but high growth, would come from Barstool Sports. I do think from what I've asked people, it's resonating with the younger audience the most. It is filling a void that ESPN has left, and it is a sound business opportunity for the media segment of Barstool Sports to actually take. And I think they should take it in all aspects of the sports industry, because the sports industry, I think, has, from what I've gathered, and this, I may or may not be wrong, comment your opinion down below, what you guys think, if you guys are avid sports watchers, that the sentiment is it's been highly corporatized, and there's a general sense or feeling that there's a disconnect between the people talking about the sports and the actual fans of the sports. And so Barstool Sports is kind of, with their different personalities, kind of honing in on that gap that ESPN, for example, has created. And if they can capitalize on that, that can, again, create a flywheel effect, in which case the media segment supports the sports book segment, which then supports the physical casino locations. If they can execute all that correctly, that's the assumption, then you could see some good results here. Now, if you want to say they don't, remember, assume, let's just take away the buybacks, putting no there. You can assume less growth, which is actually interesting. It does tell me that the company is decently cheap if they're not going to dilute you.
Yeah, I definitely think that theory of how all those different elements need to interplay in order for this to be executed correctly, I think that could actually like hold some pretty serious weight in regard to Penn National Gaming. Just me personally, this still isn't exactly a company I would invest into, which is fine. Like, you can have your own opinion. The audience can have their own opinion. Just me personally, it doesn't exactly satisfy my criteria for a company I would want to invest in. Yeah, I know.
How dare you spread FUD?
I'm guilty. I'm guilty of it every video. I know. But
I
with
actually want to poll our audience, though, on Austin. If you made it to this part of the video, please let us know if you're interested in this company, or you're currently invested in this company, etc., one or the other, and then we'll kind of read through it, because I actually want to get, and I mean, don't tell us your age, that's too much information to put on the internet, but tell us like what demographic you sort of kind of somewhat belong to, and tell us if you're familiar with the product, as in like the media segment of the business. Tell me if you're you prefer watching them or CNN, or maybe not CNN, ESPN. Freudian slip. Anyway, so yeah, if you prefer watching them over ESPN, and then look, maybe you can say why. I mean, if you tell me that you prefer one or the other, I'll understand why. I'll assume, I'll fill in the blanks. But for me personally, I want a play on online sports gambling, because I do think it's going to be a big part of the global future. For example, I was always interested, and I had a investment in the past in a company that owns FanDuel. It was a European investment I had. I don't hold it anymore. And then there was a flirtation with GAN, this other tinier company that I had, and it ran up, and I immediately sold because it wasn't a high conviction. There was not really any much my capital in it, like less than 1%. And I was like, all right, it ran up, I'm not going to buy it. And then I did more research, and I kind of was like questioning it because it was kind of like just a watch position. But I'm just kind of naming out these other companies that we might as well do videos on this, because maybe we just open the can of worms on the gambling industry. I did have a position in another tiny little position in Golden Nugget, like a watching position, and they just got acquired. So then I was like, all right, whatever. But I'm just naming a couple other companies that you may want to take a look at. But I think there's something about the Barstool brand that intrigues me, at least the potential of it. And if they even get close to something like CNN, that would be interesting. But I agree with you, Austin, because it's like, it's not these stocks that you have grown to like, the ones that are necessities, the ones that, you can kind of sleep kind of well at night kind of stocks. But for example, would you agree with me in saying that online sports gambling is going to be a big industry in the future?
Yeah, I would probably agree with that. It's just now, like me.
No, but you're right, because the difficulty is picking out which ones are the winners. You're absolutely right. So if you somehow knew that Barstool Sports was going to be the winner, that would change it, right? Like if I could, somehow were able to say, hey, Austin, I guarantee you have somehow access to guaranteed information that Barstool Sports is going to be the undisputed, number 1, number 2, or number 3, would you then change that position? Exactly.
Yeah.
But that's the difficulty. So
that is, and that's, I mean, it's good to take risks, but just to make sure that you're taking educated risks
and measured risks.
Because to kind of segue into my next point here, there's sort of a common conception that I see a lot around investing circles, and I'm a new investor. I disclose it every video, but just for the sake of this one as well, I'm new to the markets itself. And sort of a sentiment that I see is people make really not exactly super well thought out decisions under the guise of saying, oh, well, it's important to take risks because where there's risk, there's also reward. But I was reading Howard Marks, and that's not always the case.
Well, what is risk? Risk is
uncertainties.
Yes, it's ignorance. It's ignorance of something. So everyone has different risks. Risk is simply the finance talk for ignorance of something. You just don't know, but you have to know when you don't know, and that's the problem.
Yeah.
So a lot of people think they know, and they don't realize that they don't know, and then that's going to cause problems in their portfolio. And then sometimes the worst kinds of mistakes are the mistakes when you're accidentally right.
Yeah.
Why?
Tell us why.
Well, I mean, it makes sense. If you're accidentally right and you don't realize that you were right for the wrong reasons, then you're going to try again thinking you're a genius, and you're probably going to go bigger because you think you're such a genius. And I
definitely see a lot of that.
Yes, if you were right for the wrong reasons, and there could be a plethora of reasons why you were right. And also, there's another thing. You could be right time-wise, right? Momentarily right, but long-term wrong, or vice versa. You could be wrong in the like, for example, I always say Michael Burry was wrong for years. What do I mean by that?
Means that he was wrong for years until eventually he was right.
Yeah. So that's an added segue about shorting stocks. It's like shorting stocks is so incredibly difficult because not only do you have to be, you have a risk of time. Time is against you. When you're long a stock, time is on your side. So you don't have that risk, right? The risk you have in time is opportunity risk, which is different. The risk you have with shorting stocks is actual time risk because you are paying for that short position. The longer the time goes by, the more expensive that is over time. So the problem with shorting is not only do you have to be correct on the thesis, which longs also have to be correct on their thesis, but shorts have to be correct on their thesis. You also have to be correct on the timing, which is incredibly difficult. So Michael Burry, who shorted the housing market, was correct in the thesis, incorrect in the timing. And if he was just incorrect for a couple more years, he may not have had the liquidity to pull it through. And then that would have sucked because he would have been right, but he was wrong on the timing. So that's what I'm trying to say. It's like, it's also about, you could be right in the short term, wrong in the long term. And then it gets a little more complicated, just like how everything is. It's a multi-layered cake.
Yeah.
And you want to truly kind of understand what happens. So oftentimes what I like to do as an exercise, if a position goes correct or right for me, I will try to sit down and like observe what may have caused the outperformance or even underperformance if it's a losing position, and try to figure out, well, what happened. Okay, was my thesis what played out? Was it something else? Because sometimes it's been times where I invested in a long position and there's been huge run-ups very quickly, right? And it basically meets my threshold. And I believe that, it's been pricing all these things. And I will look to see, well, has anything else, new developments come out that I wasn't pricing in before? And if there wasn't, I kind of then say, I was right, but the timing, it kind of just advanced. Everything's priced in now. I should sell out. Does that make sense? And then
yeah, it does.
Kind of like vice versa can happen in the other direction as well. So we could be right that Penn National Gaming is the play for online casino gambling. You could just be wrong in the timing. Timing is a big problem. Long investing, not shorting, but long investing has the advantage of time. The time cost is simply opportunity cost. But which is not necessarily, it is a cost, but it's not the same kind of cost. And then shorting Penn National Gaming, that would be, you'd have time against you, but you could be right that it's, whatever, it's going to go bankrupt. I'm not saying that before when things that.
Yeah.
But I hope I got that point across.
I think you did pretty well. Well, any closing thoughts before I wrap up the show?
Nope, that was today? The closing thoughts. No need to ramble.
Perfect. Well, you've heard it here first, folks. We're your hosts, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really, really helps out the channel. Please be sure to visit our website at capitalmindset.org. And also, please be sure to like, comment, and subscribe, and take care.